I think like the biggest thing I've seen with developers that like you're talking about skimp at the end, right? Is that like development's kind of a slow game. Real estate's kind of a slow game. And I feel like most people have like a lot of wishful thinking. They underwrite their deal. They're like, I'm going to get it permitted quicker than it can happen. I'm going to build it for less than I probably can. And it's like a wish instead of like a plan. And so what I've always tried to do is like crunch back numbers on every deal we finish so that I know like if 5 years ago I was making $1 or $2 or $10 square foot mistake, that I try to account for that going forward so it doesn't continue to happen.
All right, guys. Today, I got someone who is a good friend of mine for the second time on the podcast, doing big things in the development space in real estate, both on the residential side and the commercial side. I got my guy, Austin Schmidt, in the building. What's up, Austin?
How we doing today?
Oh, doing amazing, man. Appreciate you coming on, dude. And so much to catch up on and a lot of game, a lot of value. But for the listeners that don't know who you are, just drop real quick. What do you do today in the real estate space?
So I'm Austin Schmidt. I started Lux Builders almost 18 years ago. We've specialized in doing single family spec home rebuilds. We've cut subdivisions and built out full housing subdivisions, townhome complexes, value add multifamily, new build multifamily, raising capital.
And how much in real estate today would you say you control?
As a GP general partner, about 400 multifamily units, 200 as a LP. I'm an investor in yours.
Yep, you are.
And
Very grateful for you being a part of what I'm building.
yeah, for
Yeah.
sure. And then, I've probably done 400 projects on the single family
Okay.
side.
And I might buy one of these luxury spec homes that you're building.
Yeah, we got to hook it up.
Yeah. So so what are you doing right now on the luxury spec home side? So I know San Diego and Denver are these markets. And I've seen one of your sites, your projects out here in San Diego in Point Loma overlooking the water. For me, I've been in the apartment game for so long, living in high rises downtown, and it's cool to walk to the office. I love it here, but I'm finally ready to get a house. And so I hit you up, I don't know, 8 months ago. And you were like, dude, I got some cool projects. Go check them out. So I went and walked one of your sites in Point Loma, ocean view, overlooking the water, custom home, 4 or 5 bedrooms, like decked out,
Yeah,
all the
it's gonna
best
be nice.
finishes. Like you guys don't cut any corners. And so I'm definitely interested in buying one of your projects from you. But what are you guys doing on the spec home side?
So I would say like the biggest change we've had in the past 2 years is that like no one's a stranger to the market. Rates have gone up. You have to be a little bit careful with how you build single family right now. I would say during the days of COVID, people were just gobbling up homes. They were paying 3% interest rates. So probably the biggest change is that we've had to be really careful with cost, and we can't like ever cut back on finish work. It's like you got to step your game up a notch so that yours is the one that catches the buyer's eye.
Mm. And would you say, because a lot of some people that invest in other asset classes, I feel like they might get to the final 15% of the project and then they'll start to cut corners because they start to go over timeline and then they start to go over budget and they start eliminating certain things. But your approach is a little bit contrarian in this space because you're marketing to a buyer that can afford a $4 million property as a single family primary residence. And you're saying these folks, they want to buy the property that has all the bells and whistles and the nice finishes, the wolf stove and all that.
Yeah. Yeah. I mean, most of the time when people get into the 3 million plus price point, they want to buy things turnkey. I think like the biggest thing I've seen with developers that like you're talking about skimp at the end, right? Is that like development's kind of a slow game. Real estate's kind of a slow game. And I feel like most people have like a lot of wishful thinking. They underwrite their deal. They're like, I'm going to get it permitted quicker than it can happen. I'm going to build it for less than I probably can. And it's like a wish instead of like a plan. And so what I've always tried to do is like crunch back numbers on every deal we finish so that I know like if 5 years ago I was making $1 or $2 or $10 square foot mistake, that I try to account for that going forward so it doesn't continue to happen.
Yeah. I've always thought that like when I get into a primary residence for me, and I think some listeners might think this is ironic because like we renovate a lot of the properties that we buy, and I'm always a big fan of like buy below market, in a good location, have clear paths to add value. But I think, for me buying a primary residence, I think I would just want something turnkey. It would be nice to be able to pick out some finishes. That's why a new build really is attractive to me. Something where you can close and then just move in. I deal with so many headaches and problems like with all these other stuff that we're doing. I don't need to have more headaches with my primary residence. And so I don't think that I would ever want to just buy this big project as a primary residence. I would rather just buy a new build from someone like you.
It's a catch-22 because you're in the real estate business, right? You're like, "I've bought things and added value." So it's hard sometimes for people to switch gears, but I will say this, I've seen a lot of people buy homes where they were gonna do massive projects, tear downs, rebuild new homes, huge remodels. They end up in a lot of debates and fights with their wife, their girlfriend. They kinda can't pivot gears from, like, going to work and putting out fires all day and then having to go home and, like,
Make more
focus on this
decisions.
other project,
Yeah.
and it's like the side project.
Yeah.
So I will say this, like, a lot of people that buy the turnkey houses, what they don't take into consideration is the fact that they have so many less decisions to make, so they walk into a finished product, and maybe they, like, wanna change some paint colors, but then they're buying something new, and they don't have, deferred maintenance that they looked past on, like, a renovation that will come up again later. That I feel like you get, like, a 10, 15-year horizon on a new build where you're just not gonna deal with a lot of maintenance.
And I like that, but there's also an opportunity cost. As a busy entrepreneur, you're dealing with a lot of fires, a lot of problems every single week. You got a team, you got all this overhead. It's like there's an opportunity cost of everything you say yes to, and then just bringing on a primary residence that you plan to live in, and then you're gonna do this big renovation. I'm like, dude, it's a time suck. It's a big time suck. Do you have project managers that you hire for all of your projects, or you project manage yourself?
Well, our team has people in-house, so we have 4 on staff full-time, and we have 5 in the office. I would say the opportunity cost thing, it's funny you bring it up because I usually lead with that, because a lot of times, like, people just really don't understand that, like, they're really good at something else.
Mhm.
Like, if they're a doctor or an attorney
Yeah.
or whatever they
It's like,
do,
keep doing more of
it's
that.
like, "Dude, go make more money being a doctor.
Yeah,
Don't try to
100%.
be a home builder."
Yeah.
And it's a emotional purchase for people, so they tend to not wanna, like, let it go. But a lot of people that let it go are like, "I'm so glad I did that."
Mhm.
You know what I
Yeah.
mean?
Yeah, 100%. And, for me, it's like, okay, if I had the time and I was like, "Man, this is the only piece of real estate that I'm working on right now," then it's like, okay, maybe I would consider it. But I got a lot going on, and all this stuff is way more important as far as my time than something like this. So, like, for me, that's why I would just go to someone like you, pay you, and be like, "Hey, you got these locations that have ocean views. They're great spots, great neighborhoods, and then you're doing these amazing build outs. It's brand new, like you mentioned too. The cost of repair and maintenance for the next 15 years probably very, very minimal, and you get to move into a brand new build. I mean, that's turnkey, easy. Like, when I close on that, I wanna just move in. I don't wanna have to deal with headaches,
Yeah,
you know?
totally.
So, I get it, dude. I get
Yeah.
it.
I think it's a huge thing.
So, okay, so right now, with all these shifts that are happening with the rate environment, today is February of 2026, and exactly 4 years ago was when we had the first rate hike, February of 2022. We've been in a high rate environment for 4 years now. How has this affected the builders market?
I would say on the retail side, like, when we're finished and going to market, we've seen it's been all over the board. Like, if you had to ask me, like, what would be the perfect choice to make today, I would literally have to tell you that there's about 5 pockets out of the 10 we build in that have not seen a dip, like, at all. And it bucks what you hear on the news. It's a price point you wouldn't expect. It's typically higher than you would expect. But, like, the luxury space, like, say, like, above 3.5 million hasn't been hit as hard, but it's pocket specific. Like, in Denver, there's 3 or 4 really good pockets. In San Diego, there's a couple around the city, Point Loma, some of the stuff that's up in, like, Encinitas. Um, you know, I think La Jolla's I've heard some stories about some deals in La Jolla that got really bought at a discount. Um, but it's really pocket specific. So it requires you, if you're a developer, to be very realistic about what you're going to sell for.
More conservative with the expectation?
Uh-huh.
Yeah, okay.
Yeah, if you're not in like this specific
Yeah. So give me an
pocket.
idea, like prior to the rate environment going up, we're talking 2019, 2021, was there a lot more margin for error to
Oh,
miss on your pro forma and
oh
still make money?
yes. Oh yes. I would bet you a third of the other developers I know will be out of business for sure. Because they ran a business for 5 to 6 years making mistakes and still making money. I was telling you earlier that like probably 3 times a month right now, I'm getting a call from a lender that's like, we have a deal that we are going to take back. They can't fix it. And I mean, these are all good people. They put their effort in it. They just took their eye off the ball, let too many people on their team make decisions, didn't watch the numbers, but they were getting bailed out by the market increasing in the past. And I think this is really where like the rubber meets the road.
In a lot of these deals that these lenders are bringing you, what stage are they in the development
I mean,
process?
most of them are done and they can't stabilize them.
Really?
Yeah. And it's
And these are spec homes?
no, these are like multifamily deals
Got it.
specifically. So like I walked one the other
These are
day.
larger multifamily?
Yeah.
New builds?
Yeah.
Dude, I believe it, bro. I was out in Scottsdale a couple months back, and if you remember correctly, like Phoenix led the nation for many years, almost a decade, in like annualized rent growth, 10%, 11% every year. And but now it's got negative rent growth, and there's a lot of buildings out there. I was out in Scottsdale, and there's a new Class A building out there, and I got a friend that lives there, and she lives there, and like literally it's like 30% filled, and it's been open for a year now. They can't lease the units.
Yeah, I mean, they're having to do like rent concessions. Um, I think like one of the, I guess I'd say somewhat scary statistics I've heard is that like in like certain parts of Denver, and I've heard this in Phoenix because we own buildings in Phoenix too. A lot of the developers have not really just taken the price cut that they need to fill up their buildings. And so it's like you're seeing these 30% occupied buildings because they're not doing a big enough discount to get them initially leased. And they're hanging on to this thought of like, well, maybe I can get, X dollars per foot if I give a free month, and it's not enough. Well, maybe I'll give 2 free months. And they're trying to keep the rent up to the rate they wanted when, I mean, if it takes them a year to fill it, they should have just.
And they're doing that because they're more concerned with the value of the property when they go to refi or do the takeout.
Yeah. Yeah. I think they're like, if I can give somebody a few free months and get my rents at the old market rate that was, when they were getting 10, 12% growth every year, that they're going to stabilize their NOI so much that they're not going to lose like $1 in value, but then they're not leasing them.
Yeah. One of the things Grant Cardone says, he says like, when you're investing in real estate, if there's cranes in the air, beware.
Yeah.
Right. And, you go to a lot of these pro builder friendly, like type of areas like Orlando or even Phoenix, you see a lot of cranes going up. But right now in downtown San Diego, you also see a lot of cranes going up. I live in a Class A building here called the Simone Little Italy. When they built this building, I believe Blackstone just bought it. But the developer who built this, right time. They were the first like new high rise in Little Italy in like the last 12 years, and it leased up right away. But today there's about 5 or 6 new high rise buildings going up that I can see just off my balcony, and those guys are late to the party, and they're gonna have. I know they're gonna have trouble leasing those buildings up.
Oh, definitely.
They're all competing with each other.
I've had much better luck with like a more stable return and doing like, say like a class B plus type, like workforce housing type product, like low cost of amenities, like, 3-story walk up surface park buildings. Like you can still make them very nice. The high rise game is it can be very difficult. Like to put it in perspective. So like when your building was built, they couldn't occupy a single unit until they got their CO on the whole building. So imagine how many units sat vacant that were done. They had been touched up, punch listed, painted. They were ready to turn and hand a key over, and they couldn't occupy them until they had the CO on the whole building. When you do like these garden level complexes, you're doing 2-3-story walk up buildings. Maybe you have 4 or 5 on a site. You can start renting the buildings as soon as one's done while you're working on other ones. And so like that model to me has always just made more sense because I'm like, I could get 20% of my rent roll while I'm still under construction. So, and then now it's 40%, and then now it's 60%. And it stabilizes faster. You need more ground. You can't build it on a small site in downtown, but, you know,
So if someone's listening to this and they want to get into development, would you recommend they get into developing single family, or would you say go in development like some small multifamily,
I would not develop multifamily until you're very experienced.
even if it was like a fourplex?
Maybe,
Maybe. Okay.
maybe.
Okay.
I think the problem is that until you like honestly, if somebody wanted to get into multifamily, I would say go work for a multifamily developer and learn how they underwrite, learn kind of the product mix of what they buy, because it's a very much like a rinse and repeat business. Like you're gonna get a unit style that you like for finishes, fit, cost, and you rinse and repeat it. And when you find the recipe that works, you just stick with it. But I think like that's where like this emotional and personal choices come in. And people are like, oh, I want to make this trophy project, something I want to be really proud of. And it's cool to do that, but like you got to underwrite it right.
Yeah.
You know what I mean?
Yeah. I mean, it sounds like if you're developing multifamily, you have two components now, because on the spec home side, you're building it out and then you have really just a buyer, and you're developing this in the eyes of what the buyer is going to want, ideally when you're finished with the project. But on the multifamily side, it's like you're developing something that's hypothetical in a sense of like we got to find renters to come in and rent these units, residents, and then we also got to find a buyer on the back end that's going to come pay for it eventually down the road whenever you go to exit. So it's almost like another layer baked in if you're going to develop multifamily.
Yeah. My favorite way to do multifamily is to literally buy sites that I can kind of build a building and sell it for somewhere like under 12 to 20 million, because it's usually not an institutional buyer. It's usually someone that's done very successful in their business. They've had like a huge tax break one year, or they're a doctor that's, you know, decided to put like a large amount of money they've saved over their career into real estate. And it's underwritten a little differently, right? Like they still get the cap rate, the NOI and all that stuff. But what ends up happening is they're like, I can kind of put my arms around this. This isn't complicated. I've only got 30 units for a property manager to pay attention to, not hundreds. And, you know, I think it's like a multiplication game where I feel like we've always done better, like building a simpler project that's going to kind of come a tier below the top rents in the market. So we're talking a class B, B plus, real nice product, low maintenance cost to the new buyer, and it's somebody that can be an individual that buys it. I've just had much better luck with that.
Yeah, I hear you. So with the spec home game, what kind of spreads is realistic if someone's listening to this and they're like, man, I want to get into the developing spec homes. I know you mentioned the spreads are a little bit tighter now, and you got to be a little bit more cautious or conservative with your assumptions. But what kind of spreads can someone expect now if they were wanting to get into spec home development?
It really depends on your amount of risk you're willing to take. So like one example is this. So say that there's kind of like three top price points in a market. Like say it's $1 million, it's $2 million, and $3 or $4 million. Obviously, $3 or $4 million would be considered slightly riskier. $1 million sometimes people think is less risky. I've seen the opposite. I've seen like where, like say in San Diego, you'll see somebody build townhomes, right? And they're like, I have to get 1.2 million for every unit. That's kind of a harder sell than like
Yeah.
a $1.8 million house.
Yes.
You know what I mean? Because it's like you're missing yards, like you're making compromises. So it's
100%.
got to be a great location.
And if I'm a buyer, I'm gonna drop 1.2. I might just say, hey, I might as well get a yard.
Yeah. So I mean, that's been one thing I've seen people make a mistake on is they want to chase this kind of like entry level price point in whatever market they're in, and the spread's low in that sometimes. And you really have to be a good operator where you know like the nuts and bolts, every little cost that goes in, because you start seeing people just like make their projects personalized to their taste, and they overbuild them for the price
Yeah.
point.
I got a question for you. So you're friends with Andrew White. I'm friends with Andrew. We hosted our holiday party at one of his projects that is in Carlsbad. Gorgeous house, something like 12 or 13,000 square feet. It's a massive house, a lot of acreage, in a good location. And that was a luxury flip. And timing, interest rates went up. He decided to refi and hold this thing long term. and he hosts like events there and rents it out as an Airbnb. But what, in your estimation, because his intention was to flip this thing and sell it. In your estimation, what went wrong with that project?
I think there's a small buyer pool at times with large 10,000 square foot plus houses. I mean, if I'm being honest, every time I've built a house that big, whether it was for like an end user where they hired us as a contractor or like, someone had approached me to like buy a house like that, that I would essentially do like a luxury flip, I've gotten like cold feet.
Mm.
I felt like I had too many examples of like where a customer hired my company to build for them. And you build a long-term relationship with these people. You built their house for a couple years, then they occupy it for a few years. They call you like, "Hey, can you come look at something? Like my pool guy is telling me this, but I don't know what to believe." And you get in the house with them, and I would say half the time they're kind of like, "Man, this is a lot to take care of. Like, I don't know if I like this." And don't get me wrong, some people like it. They're like, "Hey, I did great at work. I had a really successful year. I want a trophy house," and they love it. But it seems to be like half end up wanting to sell them and go get something smaller. It's not tiny. They don't go from 10,000 feet to 2. They go from 10 to like 5.
Why? Because they're not satisfied?
No, I think that's just a lot of maintenance. And I think people start to not use a lot of the space, and they're like, "Why am I paying for this?" I mean, I have like one customer that we built a house for that has 6 kids. He is one of the only ones that's been like, "I'm good. This is what I wanted. I'm good, bro." Most of them, I mean, you have 4 people living in a 10,000-foot house, and it starts to become a little overwhelming.
Well, you almost need like a full-time person to like just live at the property just to maintain it.
Right.
You know what I mean?
Yeah.
I'm learning that in the boat game right now.
Are
So with
you?
my boat, it's 62 feet and my old boat was 36 feet. And so, you use a management company and they'll make sure the boat stays clean. The bottom gets cleaned, like all the basic maintenance, the oil changes, everything just happens. So, you just show up and use the boat and everything stays, very, very well kept. But with the bigger boats, the cost of maintenance in having like this management arm is very expensive. A lot of these companies they'll pay their staff $30 an hour, but then they'll charge you $150 an hour. And the boat game stuff's always breaking. So I was just telling Lauren this morning, I'm like, I think the move is just to hire someone full time to be dedicated to this boat. And so, instead of us having all these different people that do this and that and, detailers and cleaners coming every week, it's like we just have one full time person that just dedicated the boat, making sure it's clean. And then by doing so, now when they have downtime, they can, bring in additional revenue for us and we can, we're doing workshops on the boat now. Other people are hitting me up. Hey, they want to use it for their workshops and stuff like that. So there's definitely an opportunity for us to bring someone in full time to lower our costs of maintenance, but then also in their downtime, they can bring in additional revenue for this boat. So I was just thinking for the house thing, a 10,000 square foot house, you almost need someone full time to just maintain the house,
Oh, yeah.
you
I
know?
mean, this was probably like 10 years ago. I was at one of my customers' house. I built like this 20,000-foot house for these people, and they were like, "Yeah, you wouldn't believe what our watering bill is for our lawn." And I was like, "What do you mean?" And I mean, what would you say is expensive watering bill to water a lawn?
Oh man, a single family residence, I don't know, $1,000 a month,
Triple it.
three
Yeah.
thousand dollars a month.
And then you
Damn.
then you factor in like the guy that comes by with the crew to do the gardening and mow the lawn. I mean, it was like 7,000 a month for like 8 months a year.
Damn.
And that didn't even get inside the walls.
Damn.
And I think that's the part that's like sort of fatigues people sometimes with the larger homes like you were asking earlier. And I look at it like it's just like anything. Like, I'm sure you've met people that have like a big car collection, right? Maybe they have 20 cars and they're like, "I love cars. I want every car that I've ever dreamt about." And then sometimes they just sell them all. They're
Just get
like,
over it.
"Just give me one,"
Yeah.
you know?
Sometimes less is more. Simple is easy and less is more. So you think with once you get into 10,000 square foot plus, it's a risky ball game to play.
I mean, you need to be committed to a higher maintenance cost, and it's usually higher than you expect.
Sure. But if you're developing the larger stuff or fix and flipping the larger stuff, what's the number one piece of advice that you would give?
This is not my expertise. I'm going to tell you, like, I have friends that do that, and it seems ultra risky to me, and it freaks me out. It makes me like literally be like, "I don't know how you can do this."
Is that because if you don't find a buyer, you're now stuck with
Well,
this
there's
this
no
huge
exit.
huge mortgage payment?
There's no other exit.
Yeah.
What if you, Rich, are like, hey, I want to go buy this house and I want to flip it and make it unbelievably gorgeous. I'm going to hire the best designers. Everyone is in your ear with their opinions. And you say, I'm good. Let's go with it, right? You roll all the dice. You're like, I'm going to do this house that's going to be 8, 9, 10, $12 million. And everybody that walks in is like, I don't like it. There's no other exit. You got to sell it. Or you just got to
Or
become
or
your house.
or do what Andrew's doing. I
Yeah.
will say this. So the closest to like a luxury thing I've ever done is my Scottsdale luxury Scottsdale property. But I bought that below market value, 1950s construction, North Scottsdale, 64th and Shea, in the Orange Tree Golf Course area. And I was doing a 1031 exchange out of a multifamily deal in Indy. And anyway, so I knew my ability to buy, and I was like, I'm gonna do like a luxury Airbnb out in Scottsdale. And so I went and found all these like luxury but like tired homes out in Scottsdale. Found this one, 1.2 acres on a golf course, corner lot, and not a lot of like neighbors to worry about, right? And so I thought, man, it's a great home. It was like at the time it was only 5 bedroom and I believe 8 bath. Yeah, 5 bedroom, 8 bath, and it had a guest house. And so, but it was 7,600 square feet, so a lot of hidden rooms. So I converted it into from 5 bedrooms to 8 bedrooms, and now it's 8 bed, 8 bath with a 3 bedroom guest house. And then it had a pickleball court. It had a pool, saltwater pool. I added a beach volleyball court, a full court basketball, a putting green, a speakeasy, a gym, and like an arcade room for kids. And I did a nice reno. I put in about 750 to 800. Bought it for 2.4. My cost base is about 3.2. It appraised at 4.9 was appraisal. I think the true market value is what a buyer is willing to pay. But it did appraise for 4.9, and I refied it, pulled most of my money out, and then I Airbnb it. I will say this is my most profitable Airbnb that I have.
Really?
And if I was, yeah, check this out. If I literally was just, I didn't have a team and payroll, and I had a very basic lifestyle, this one property I could live off of. After the debt service and everything, it cash flows about $220,000 a year.
Wow.
It's just that's impressive, right?
That's pretty good.
It does top line between 6 to 700K. Top
Wow.
line. Yeah.
Yeah.
A Machine Gun Kelly rented it for back 3 years ago, Super Bowl. When the
Okay.
Super Bowl was in Arizona, it was like, I think it was the week after the Waste Management or the week before Waste Management. But he booked it for 7 nights, $62,000, canceled it 2 weeks before. And then the CEO of Warby Parker, the glasses, the CEO of Warby Parker, he booked it 3 nights for 42,000 for that weekend. But what I was saying is this: in the luxury space, if you're in the right market, the Airbnb thing is an option, but you got to be in the right market. Like North Scottsdale is one of those very unique markets to where it works. You got spring training baseball, you got 4 major sports: NHL, NBA, baseball, and you got football. And then you have the waste management golf thing. And then it's like kind of a snowbird area. So in the wintertime where it's cold in other parts of the country, people go there. It's one of the few markets where this model works. But you get caught in a luxury home in, I don't know, like Denver. I don't know if you have that as an out, right?
I don't know if you would. Yeah. I mean, I think there I have heard some stories of like, like ex-Bronco players, like their homes getting sold. Maybe the person that bought them like went BK, went back to the bank. Somebody buys them, turns them into an Airbnb, but they don't stay out very long. So I can't imagine that they had like the success you did in Arizona.
But
That kind of surprises me, honestly.
yeah, but here's the thing. And I'm going to hold this property for a long time. I like Scottsdale, it's a good market, and I have no reason to ever sell this asset. But if I ever was to sell it, it's like, who's the ideal buyer? Is it an Airbnb investor, or is it like, someone that wants this big baller home? Maybe it's a professional athlete. I don't know. But either way, if it's going to be a primary residence, like, I wouldn't want to buy a property that's been ran through by hundreds and hundreds of guests. I wouldn't. If I had the money to spend like that and I want a nice primary residence, I wouldn't want to buy like a pre-existing Airbnb. So it's like, I will run into that issue one day when I exit. Like, who's the ideal buyer for the property? I don't know.
Yeah,
you know?
it might be that you just have to go through and do a reno and
Yeah, put a
refresh
couple
it.
hundred grand into it.
Yeah,
Yeah,
and then you
and that's
turn
okay
it,
too,
someone's really excited about it
and
again.
that's okay too. Yeah.
Yeah. That's impressive though.
It is, yeah, and it is, and you never like, with these Airbnb projects, you never really know how it's gonna perform until you do it. You just don't,
Yeah.
you
Why
can
don't you do more of those?
um, I would consider doing another project like that, but we're so hyper focused on the hotel game right now, and remember at the top of the show, I was telling you, like, opportunity cost of my time? That's a time suck, and, it's a distraction towards the main thing, and the main thing is the boutique hotels. Yeah.
That's kinda how I feel about development too. Like, I own 2 Airbnbs. I have a bunch of multifamily, and I've kinda, like, tried to be like, "Alright, look, if I'm gonna be a good operator, I gotta divide my time." So,
100%.
all of my multifamilies, I hire a third-party manager, and it's just quarterly reviews. If they start to not perform, I would wanna replace them. And, I'm very upfront about it. I'm like, "Look, don't overpromise to me, and, we'll get along just fine." Um and that keeps me focused on the development business,
That's good.
and then, like, the Airbnbs that I have too, like, I don't manage them because it's like, I'm gonna be getting calls from guests, and people are gonna be, like, asking
Yeah,
questions about
who manages them?
here, I have one in San Diego, and I have a real estate agent that manages it, and in Vail, Colorado, I have one, and there's a local real estate
Okay,
agent that
okay.
does it up there
I
too.
gotcha. With the one
Yeah.
here, how does that one do?
It does okay. It's not like a fully, like, refreshed home. It's one that we kinda did a real quick reno because 'cause we're gonna tear it down to build a new house.
Oh, got it, got
So
it,
it
got
was
it.
kinda like put the short term in it for, like, 2 years while we're permitting it and planning.
Does this one have an ocean view?
Oh, yeah. Oh, yeah.
Mm.
Yeah.
Hey, what happens if, with neighbors with these development projects? So I heard the grapevine, that a couple of my old partners that I, got in the multifamily game with, we were all air traffic controllers. We, like, quit our jobs and we got into the real estate game together. And in 2022, I split off from them and I started Summers Capital, and, we still own a couple of multifamily deals today out in Greensboro. But anyways, one of my podcast guests told me the other day, a couple months ago, he came on and he's a big like ADU development guy. And he said that one of their projects out here in San Diego near the coastline got hung up by like a neighbor, like basically saying like going to the city and saying, hey, like basically filing a lawsuit saying like, hey, like I don't approve the development of this project because it's doing blocking my view and this and that. And so I guess it's holding up a project they're doing. So, I guess my question to you is, how much say, like, in these areas does a neighbor have, like, especially in the coastal commission?
So, I mean, whenever you own the property, you have use by right. So if you design everything where you aren't asking for a special, variance or special adjustment, technically they can stir up a fuss and not really be able to control anything. What happens though is that, you know, anytime a neighbor tries to make it sound like a dispute, like probably what happened to your friend, is essentially the development departments will be like, "Hey, this sounds like a civil matter. We have nothing to do with it. You guys need to go figure it out." So I think that's like where it's like people get caught in the mix, right? It's like, well, is this like your use by right, or are you asking for something special? Like, what if the city told you you could put 4 units on this site for ADUs and you're trying to put a fifth, right? That's where the neighbor could like raise their hand, throw a stink. All of a sudden, the city's like, hey guys, I told you 4, you asked for a variance for 5. Now you've made your neighbor mad. Go handle it. This is outside of our control.
Sure. Well, they're turning a single family they're not doing what you're doing. They're turning a single family home into, like 20 units in a residential neighborhood right on the beach. So I could see neighbors getting pissed off.
Yeah, I could yeah, I looked into some of these sites like 2 years ago, and I literally was just like, if I drove down this street, would I wanna see like 20 apartments in the backyard of a house? And I get it. It probably is an income producing project, but I'm like,
There's
would
not
I
a feel
want
good
that in
about
my
it.
backyard?
Yeah.
And I might not.
Yeah.
So I was like, that's not my thing. I'm not gonna do it.
For sure. It's funny you mentioned that because one of my friends, Ian and Elena, they just sold their property in Claremont and they moved to the East Coast. And they asked me if I wanted to buy their property before they put it on the MLS. They said, hey, like, you can do like 10 or 12 units on our backyard if you wanted to, because they looked into doing it themselves, but they're like, they were going to move. So they were like, hey, if you want, we can do this transaction with you, like off market. before we list it. So I went and like looked at it, but I didn't end up doing it. But their neighborhood, the street that they're in, there's like a bunch of these 12 room or 12 unit boxes on these like single family lots. And this is like a 1950s residential like cul-de-sac, and it just doesn't look right. And there's no parking at all, like literally zero parking. Like the street is just, I don't know where people park. And it's a residential neighborhood, and yeah, I could see the neighbors just not liking what's going on.
Yeah, I mean, I feel like, doing this for as many years as I have now, I've definitely seen where like zoning has changed in an area and like cities have walked it backwards. Like they got real progressive and like in Colorado they did the same thing, right, with the ADU law, but they wouldn't let you put 12 in a backyard. They went a little extreme here in my opinion. And I think, there's a story to tell, right? Like they're telling the story of like, hey, we have a housing shortage. We need to give more affordable housing. And I do believe that's a good thing. But I think you got to control it a little bit. It's like pump the brakes, guys, right? And I think they don't intend for people to turn it into like, well, now I've learned how to manipulate and read the zoning code. So instead of putting like two ADUs in a backyard, they're like, let's do 12.
Well, and that's what these guys are doing. They're like, what is my floor area ratio? What does this code mean? What does this code mean? And they're like, all right, this is the max possible density I can do. And they like, people are like, literally like, they're studying that stuff.
Oh, yeah,
I
for
mean, I have
sure.
guys on my podcast that are coming in and spitting
Yeah,
their
yeah.
game, and they're like, damn, we could do, 24 units, which is crazy.
I mean, I don't know. I've always lived by that old like Warren Buffett mindset where I forget what show it was. I watched some documentary about him and he's like, if you couldn't explain it to your grandmother and she wants to listen to you anyway, right? It's your grandmother. If you couldn't explain it to your grandmother and feel good about it, you probably shouldn't do it.
That's really good. That's really good. Another good one is this. It's invest in areas where you would put your grandmother's last $100,000,
100%. Yeah.
and you'll never lose money.
Yeah.
And that's pretty good.
So there was a like in Denver, we have this like online publication that gets like emailed out. You pay subscription to it. It's called BizDen. And there was an article recently about a guy that syndicated a lot of capital, right? And so one of the things that happened was he got busted by the SEC. And I know people that know this guy. Apparently, he's a very good guy, very good at what he does. But he had a marketing doc that said that he was going to place capital in every single deal he did. Well, the demand for his deals got so high that he started saying, I'm just going to raise it all. So to go back to what you said about like if you wouldn't put your grandmother's last
Yes.
$100,000 in, it's pretty interesting to see how like if you get successful at what you do, some people bend rules. And this guy got like, I mean, he got slapped by the SEC. He'll never raise capital again because his marketing docs contradicted his actual like SEC paperwork, like the PPMs and all that. And that was the argument of all the investors. They were like, he said he's always going to have the last 5% in, and he stopped doing it.
You're seeing a lot of the I noticed this I was telling the team the other day, some of these very aggressive multifamily guys that were syndicating, like they used to come to our meetups here in San Diego, and they'd be at every meetup. And I'm like, these guys don't come anymore. Like they've been kind of quiet online. I don't see them on social media anymore. And then I'll talk to some of these investors and they're like, yeah, like we haven't seen distributions in a couple of years. There's like lawsuits going on. I'm like, damn, it's crazy. And then I'm like, damn, where have these guys been? I'm like, yeah, it makes sense. Like these guys don't show their face anymore at our meetups. So I don't know. It's interesting to see, but you saw it in 2021. There was a big run up in multifamily. People just like crazy. And that's when I pivoted over to the hotel game. Because stuff that we were looking on the multifamily side, it didn't make sense. And then these properties would have 30 offers, and then you would go back and like see what they traded for, 2, 3 months later, and like 5 million over ask. And I'm like, what are these groups seeing?
Well, so this is where I always tell you, like, I believe if you're going to be an operator, you should be a good operator. I think the cost of capital was pretty low for quite a while, right? Like
For
we had
sure.
low rates,
2.5%.
lots of, banks would tell you they had all-time highs in deposit bases. So that essentially means there's liquid cash, right? And I think it got easy for some people to raise money and they're like, cool, everything goes up over time. It's going to inflate. Sometimes it does, sometimes it doesn't. I mean, if you were in office, I mean, office is getting clobbered right now. And
That a lot of that's technology, though.
I agree. I
Yeah,
agree.
the need
But
for office space has definitely gone down, and like we got a really good deal on this. We just renewed another 3 years, but technology is shifted the way office is done.
I agree with that. I think the point I was trying to make is this, is that, like, if you're gonna go out and be an operator, like, okay, why are you not telling your investors, like you're talking about with these multifamily syndicators, what's actually happening even when it's bad news,
Mm,
you know?
mm, yeah,
I mean, you should,
yeah, 100%.
I feel like that's usually where you kinda separate a good operator from a bad one is, like, you know, if you're embarrassed to tell your investor group, like, you probably shouldn't be raising money,
Yeah.
you know?
You raise money,
Oh, yeah.
and talk about what kind of projects you're doing with your investors.
So,
Because you have a couple, right? The
yeah.
spec homes is one, and
Yep.
that's one investor avatar,
Yep.
and then you have more of a long term thing too, right?
Yeah, we'll do, like, kind of like a stair-step approach where we'll get people in kinda like a 1 to 2 year deal cycle, and that's usually like a spec home. It depends on permitting was pretty slow during COVID, but outside of that, it's usually a couple year process. So that's like one. And then we'll do subdivisions sometimes where we'll get a group together, we'll raise money, we'll cut a plot of land, and then they'll have like kind of a phase two where they can stay in and either the dirt trades to the same group, and then we'll build all the homes and sell them. So it's like a two-pronged approach. Those are longer projects. And then we've done like value add and new construction and multifamily. And typically like we try to stay in like that workforce housing space. I like that space. I feel like you're not chasing the top rent in the market. You can build a very nice, clean, comfortable building. They tend to stabilize easier. They tend to have less turnover. They tend to like not see as big of rent bumps. But, I think stable's good,
Yeah,
you know?
yeah, I'm with you on that. I think like whenever you're trying to set the record and rent in a given market, that's not a good place to be. I always say like figure out the comp set, whether it's multifamily or even in buying hotels. It's like look at the comp set and then try to be in the middle or somewhere realistic to where you don't have to set the record in order to still like have a successful project.
Yeah.
You know?
Yeah. A few years ago, a buddy of mine had a really close friend that built a big hotel in a city. I don't want to say where it is, but they tried to break the record like what you're talking about. And I mean, this was a place where you could go rent hotel rooms for like $200 to $600 a night. I would say most of them were 200 to 300, and they went out and just tried to hit like 750 a night, and it never happened. And it was like, why'd you try to break the record? You had
Yeah.
a great location,
Yeah.
you know?
And same thing with the multifamily game. It's like, dude, you got to know the markets and you got to know like what are residents and tenants willing to pay for. Although there is a really nice hotel that I just thought of. It's called the Ambiente Hotel in Sedona, Arizona, and it's a landscape hotel. I've had podcast guests come on and like all they do is landscape hotels, and I've never stayed at one until I think it was last October or November. Went out to Sedona, first time out there. Have you been? Freaking stunning, stunning. I'm like, okay, I get it now. Gorgeous. So there's a new group went in there. They did a 40-unit landscape hotel. It's like these individual buildings and structures. And so each resident that stays there, basically, you get this own like individual structure. Really, really nice. Like basically one bed, one bath. It's got a kitchen, and then it's got a rooftop, really large rooftop patio with a fire pit, and then gorgeous views of all the mountains. And then at night you see all the stars. It's absolutely stunning. And then they have a Michelin star restaurant on the property. And these guys are cranking crazy ADRs, like two to
Really?
$3,000 a night,
Really?
and driving like really, really strong occupancy. Yeah. And so this is the first time I stayed at a landscape hotel like that. And I was like, damn, like this is I get that now in the right areas done right.
Yeah.
I get that.
What was this one called?
It's called Ambiente.
Ambiance.
Ambiente
Okay.
Hotel.
I'll have
So
to check it
if you're
out.
listening to this, you going to
Yeah.
Sedona, go stay there. Like it was dope.
Okay.
It was dope.
I've never stayed in one of those either. They look cool. I've seen pictures on
Yeah.
Instagram of these concept, but I've never
Yeah.
stayed in one.
I was like, damn. And so it was impressive. I was kind of talking to them, and because I'm always, when I stay at these, boutique operations, I'm always curious, like, what kind of like year-round occupancy and ADRs they're driving, and it's crazy. It was impressive to see what they drive,
Yeah.
but that's unique, but that's a high risk project because you're developing that stuff, and you know, the ADRs in Sedona might be 2, 3, 400, 500 during like high season. And so for you to come in there and be like, you know, it's hypothetical. We're going to have an Instagram page and we're going to drive $1,000, $2,000 a night ADRs. It's hypothetical until you do it,
Yeah.
you know?
And it could be short-lived, hopefully not, right?
Yeah,
For their
100%.
yeah. Well, I mean, would you ever do one of those?
Not in the near future. For right now, we're kind of hyper focused on, for us, we like to get in and get out. And so we'll buy a hotel and the renovation period is going to be anywhere from 2 months to 6 months, depending on the size of the hotel and what it kind of looks like. But it takes a lot of the risk off the table, you know? And so we're coming in there. The biggest risk to our model is when we shut down the hotel and we do this renovation. There's no income coming in for 2 months, 3 months, sometimes 6 months. You can go over timeline, you can go over budget, you know this better than myself. Contractors can disappear, like that's the biggest risk to the model. But once you get through the stabilization period, now it's like, okay, the biggest risk is behind you. There might be a time in another season to where we maybe get in development stuff, but it's not my forte. It's honestly something that I don't, you know, it's not my bread and butter. It's not my competitive advantage. And so it's just not something that we're interested in right now. And also we're seeing a lot of value. Like we're able to buy these like mom and pop owned, you know, boutique hotels at a discount. And often we're picking them up below replacement costs, you know?
Hey, if you got a model that you like, I would stick with it.
Yeah.
I think changing gears and pivoting is where operators just make tons of
Yeah.
mistakes.
Like the San Clemente deal we bought this year,
Yeah.
4 stories, subterranean parking. The top 2 floors have ocean view, um, 18 rooms. It's got that classic Southern California look, Spanish red tile roof, palm trees. We got that below replacement cost. You can't build it for that cost today. And so, you know, when I think about that kind of stuff, I'm like, I don't think I would get into development. And if I did, like it would have to be kind of that really vibey landscape thing. But then now you're talking a lot of risk, high reward.
Yeah. I mean, that is kind of the development game is like, you know, most people don't have a good vision, right? So if you create the vision, like what ends up happening is you got to go all in. Like you can't go halfway. Like you were talking
Mm-mm.
about the guys
No.
that cut the last 15%.
Yes.
Like you got to go as all in. I mean, within reason, right? Like nobody's putting pools on tops of houses and stuff
Yeah.
like that. But um, yeah, you got. I mean, you got to have the vision and go all the way in. But the cool thing about development is that when you change the landscape in an area, so like say you went into like Claremont where you were talking about that deal with the 12 ADUs, right? I mean, if you were the first person there that did it and it was successful, it probably will continue to happen and you'll be on the forefront of it.
Yes.
And I would say sometimes being at the tail end
Is where you get shafted.
is harder.
Yes.
Yeah. So, I mean, usually that's kind of what developers do is they kind of look where the path of growth is and they're like, I'm going to buy in that path. Like, I mean, you know, like Ted Turner and what's his name? Stan Kroenke, they're like the largest landowners in America. That's all they're doing is trying to buy land that's somewhat in the path of growth,
Yeah.
even if it's like 30 years out,
Mm.
you know?
But I think it's not just in development, but it's every niche in business and real estate that you get into. If you're late to the party and you're like one of the last ones getting in, those are the people that lose money. Like the whole Bitcoin thing. People were buying it when it was 100,000 and they're like, hey, this thing's going to 1 million. I mean, I had guys on this podcast that are, and maybe it will go to 1 million one day. I don't know. But I still don't understand how Bitcoin works. And I've interviewed people on how it works. I still don't understand how it works. I understand how real estate works. You know, it's very simple. It's tangible. You can look it, you can touch it, you can feel it. Real people live in these properties. They stay in these properties. They work in these properties, and you can get great lending on real estate. There's a reason for that because the banks see it as a low risk asset. You can't get great lending on crypto or buying stocks. Now, a lot of people were getting in the Bitcoin game at 100,000. It went up to 120. People were still buying, and now it's at like I think 60,000.
Yeah.
That's
I mean,
crazy.
most of the finance guys I know that are like, you know, working in Wall Street type organizations,
69,000, but it was at 60,000 like a week ago, right? Week and a half
I
ago?
think it did. Yeah. I think it was like 62 or something. All the Wall Street guys I know that work in those organizations, they don't understand Bitcoin. Most of
Mm,
them don't like it.
they don't know how to explain it.
They don't like it. Like they're like, I tell all my clients, like, if I can't understand it, you're not going to understand it. I work in the, you know, they work in finance every day.
Yeah.
So
But
a lot of them
you
don't
even
like
seen real estate guys, Grant Cardone's one of them,
Mm,
dabble in the Bitcoin game. So Grant has, I know last time I talked to him, he had one fund where they're buying multifamily. The equity is protected by the asset, the multifamily, but then the cash flow distributions to investors, instead of the investors getting cash flow, the distributions would go into a Bitcoin bucket. And
why do you think he did that? I have a guess.
go ahead.
I think it was marketing.
Mm.
I don't know that it's a terrible investment. It might not be over
Well, it
time.
could work out in
Right.
5, 10
But
years. You don't
it
know.
feels like marketing to
Mm.
me. You know what I mean? Like it's a differentiator, wouldn't you say?
It's a contrarian viewpoint.
Yeah.
Yeah, yeah, for sure. And you can show a target return of, hey, if Bitcoin does go to 1,000,000, yeah, like instead of
Right.
a 16, 18% IRR, you're gonna get a, a crazy multiple.
Yeah.
And so I think some guys might like that, it's a different appetite for an investor for sure.
Yeah, totally.
But again, I don't understand how crypto works and, most of these coins and the NFT game and all that stuff. It's like all that stuff it went to zero.
Yeah.
You know what I mean?
I don't understand it at all. Like I've had people try to convince me and talk to me about it, and usually I just shake my head and I'm like, I can't follow this conversation. So I'm like, if I can't understand it, I'm out, you know?
I mean, even some stocks, it's like, what are you buying? A ticker symbol, you
Right.
know?
Yeah.
But real estate, it's like, I think for the everyday middle class American, I think buying a piece of real estate is the easiest path to become a millionaire.
I think it is the easiest path to become a millionaire. And I think it is one of the easiest for people to get their arms around and understand. And I think like if you do real estate deals that are not too complicated, like it's like, the old joke, don't go above your pay grade, right? I feel like what you just said is true. I think that's the quickest path to be a millionaire because you can literally just buy real estate and wait. And usually the market will do good things over time, but you have
Mhm.
to be really patient,
Mhm.
you know?
And because it's not liquid, it forces people to kind of hold on to it longer than stocks and crypto and all that sort of stuff, which is more emotionally based. But what do you kind of foresee here in 2026? We just had a new Fed chair be appointed by Donald Trump. So Jerome Powell's out of office. Looks like May of 26. And this guy was it Mark Warsh is going to be potentially taking over the Fed chair. We ended 2025 with 3 consecutive rate cuts. What do you foresee as far as rate cuts in 2026?
Ooh. Um, Man, if I had to bet and make a guess, because I think we're all guessing, right?
Yeah,
I,
we're all speculating. We won't hold you to it, Austin.
I feel like it's gonna get more aggressive on the rate side. I mean, I don't know if that's gonna happen like day one of the Fed chair, but I mean, you just gotta think about it. Like I know it's the Federal Reserve Bank and it's supposed to not be connected to politics, right? Technically, it's supposed to be independent. But I feel like they do weave in and out a little bit. And I think most people would assume a new Fed chair would want to make a splash, right? How can you make a splash? Probably by making rate adjustments. And I also feel like our president has really promoted this. And I think he's going to be very influential as much as he can. And so I would bet we'll see some adjustments. Um, I also
Do you think
think
the next cut will be in May?
I don't know. I bet you it comes like pretty quick after the new Fed chair.
Yeah, and you don't anticipate any cuts until then.
I don't think so.
Okay.
I don't. Yeah.
Okay. And how many basis points worth of cuts do you anticipate this year? I'm not going to hold you to it. We're all speculating.
Um. What would I like to see happen,
Yeah.
or
What
what
would
do I
you?
think will
Well, give me
happen?
both.
I think I'd like to see, rates be around a low 5%. I feel like that's a healthy rate. It's good for the banks. Yeah. Do I think it's going to happen? Maybe. I don't know if it's going to drop a whole point from kind of where it's at right now.
Okay.
Like that's like, residential, like consumer mortgages right now are hovering a little below 6 for like 30-year debt, just, between 6.15 and like 5.9. I mean, I'd like to see that number at like 5. I feel like if it stayed there,
For like a buyer that's buying one of your spec
like a
homes
consumer,
wants to get a
right?
30-year
Yeah,
30-year fixed mortgage on a primary residence, you want it to
totally.
be around like 4.9, 5%.
Yeah, exactly. I
Okay.
think that's like a healthy rate where the banks can make money. I think it's
Yeah.
fair for the consumer to
Okay.
pay.
And that's where you would like it to be.
I would like it to be
Okay.
there.
Why not lower?
I mean, I'll take lower.
Okay, you
It's
would.
good for
Okay.
the business,
Yeah.
but it also creates this kind of like boom and cycle in a business. And I feel like looking back, like probably one of the most consistent times in my company, rates were hovering right around 4.75 and 5.15. It happened from like 14 to like 2018, 2017. And when they were like really consistent and they didn't jump up and down much, we did really good. Like people were like very accepting of it as a consumer. We could underwrite deals without a major change throughout the cycle. It just felt good, honestly. It felt like stable, and it felt like you could run a business and not feel like there was a variable there. So I'd love to see that. And I will tell you, like most of the bankers I have good relationships with, when rates were like below 3, they were like, this isn't gonna last. They're like, we can't do this. It's just not good for the bank over time.
Well, Trump's been very like vocal that he wants to, target federal funds rate around like 1.5,
Yeah, I mean,
which will put in the all-in rates, sub 4,
yeah, it would.
three
I
and a
think
half.
that's aggressive. I mean, we'll
But
see
you
if
would
it
take it. You
happens.
would
I
take it.
I would take it, but if I was a betting man, I would love to see it hovering around 5.
Yeah. Okay, and then what do you think we're gonna see?
As far as the rate,
Yeah, this year. How many basis points worth of cuts will we see in 2026?
I bet 2.
Austin Schmidt.
I bet 2.
200 basis
No,
points?
2 cuts of quarter
Okay,
point.
so just 50 basis
50.
points.
Yeah, that's what I would
50.
guess.
Okay.
What do you think?
Phew. I would like to see 100. I think 100 will be a win,
Yeah,
but I wouldn't conservatively. I think we'll see 50 to 75.
yeah.
Yeah.
I agree. I think that would be good though. I think it would show some movement, and it would probably stabilize things even a little bit better than they have. We've actually seen the market pick up quite a bit since the beginning of the year.
Now the question is, when will spreads start to come down? Because there's the 3 rate cuts at the end of the year. The 10-year Treasury went up. The spreads have been up. And as a matter of fact, when this guy Mark Walsh, I gotta look his name up on chat. What is this new Fed chair's appointed Fed chair?
Yeah, he's about to be
It's
in.
it is Kevin Warsh. I was way
Okay.
off. I said Mark.
Yeah,
Kevin Warsh.
yeah,
That's a hard one to pronounce. Kevin Warsh.
yeah.
So the confidence in the marketplace has actually not been the greatest since this guy's been appointed.
Really?
So I mean, yeah, spreads have kind of come up a little bit, and you see the market respond. Like as far as the stock market came down a little bit
Oh,
when
for
when this
sure.
was announced.
Yeah.
So
Yeah,
we'll
this
see.
week was pretty crazy.
We'll see.
Yeah.
But it's all speculation. But anyways, when will spreads come down? That's the real question.
I mean, we just really need to see the 10-year Treasury come down. I think when that comes down, we will get very stable. Because the 10-year has been hovering and not changing as much as like the Fed cuts have. You know what I mean? So that's really what I think controls that long-term debt spread the most.
Were you developing prior to 2008?
Yeah.
Okay, so
Yeah.
you've seen '08, you've seen the COVID thing in 2020.
Yep.
And then you've seen this slowdown with the rate environment. Which one was the most difficult out of all these?
07 to 09, 100%.
And how would you compare this one and what happened in 2020 as a developer?
So 2020, I would say the biggest challenge was not sales. The biggest challenge was deliveries, for us to deliver product, because permits got way behind. All the government workers were going remote in all the permitting offices. So all of a sudden, like durations extended because of that. We saw like a lot of shortages on materials where, if you didn't have a big team, like you would have been in a lot of trouble, because you'd place an order for something and you'd be the only one to take the phone call, and they'd be like, "Hey, this window manufacturer cannot ship this for 24 months." And you'd be like, "I need this in 2." So we had to constantly like pivot, make new changes, decisions, to keep things running on time, because they had like factories shut down. Like they were not shipping stuff. And then this time, I would say the supply chain's gotten much more stable, but it's been a little bit more of like a consumer confidence this time. Nowhere near like '09. '09 was like scary to people. Like they were just like, maybe we don't need to own a house. there was like foreclosures everywhere. And I mean, it was like you'd go down streets and there'd be 5, 6 homes on a 10-home street for sale. Um, this one's a little different. I would say this one is almost like um, sellers have very wishful thinking. They want it to still be 2022. And I think everybody could be accused of that at times, right?
For
You get
sure.
a price tag in your mind, right?
Yeah.
And then buyers want it to be '08, and it's
Mm.
not either one of those.
No.
It's kind of in the middle.
Mm.
So I think what's going to be interesting is this year, I feel like a lot of the multifamily debt that's getting reset with the debt coverage ratio, I think a lot of that's going to get called.
Mm.
I do. We've
Mm.
actually looked at like several deals every couple
On the
weeks.
multifamily side.
Yeah, I think the can has been kicked down the road on these loan extensions, and I think you're going to see quite a few banks call notes. Hopefully we can buy some of them.
Yeah.
Yeah.
Yeah. And these are a lot of, because for the listeners listening, a lot of these commercial loan products, especially with the fixed, typically 5-year terms on the multifamily side. And so, a lot of these operators locked in some pretty cheap debt in 2020, 2021. And so now we're in 2026, which is kind of puts you at that 5-year maturity. You mentioned a lot of these lenders want to do extensions, but there's only so much extensions these lenders can do. And so you said you're seeing some of these opportunities come to you. What
Yeah.
are you seeing?
So like an example, like I got a call from a lender to go look at a deal that was like completed and unrented,
Yeah.
vacant,
Yeah.
16 townhomes, and lender took it back, right? And they're like, hey, here's the number. I would say the number wasn't where we would need to buy it at, but we went and walked it. And, this specific project was
Built to rent or built to sell?
it was supposed to be built for sale.
Okay.
Then they couldn't sell them.
Mm.
So then it turned into build for rent.
Okay.
And then that's when they got in trouble.
Mm.
And so it
Because they
never
couldn't
got,
lease them up?
it never got occupied. It sat empty.
All 16 of them?
Yeah, sat empty.
So they didn't
16
even try to
townhomes.
lease them up.
Well, listen to this. So the guys were like, yeah, we think this is a great deal. You guys would be the right guys to turn this around, rent it, sell it, whatever, right? We go walk the buildings, and these are 2-bed, 1-bath units with only 1 bathroom inside of a master bedroom. So this means like you have your friends over to your house and they're like, hey, Rich, where's the bathroom? You're like, oh, go up through my bedroom upstairs.
Damn.
And the bathroom's back there.
Damn.
And,
They didn't put a second bathroom?
everybody's going to be looking at you like, you only have 1 bathroom in your house?
Damn.
It's such a floor plan bust. Like, I don't know how you could do that. I
That's
couldn't.
tough, dude.
I literally was like, I'd buy this, but I can't fix the problem.
Damn. Who advised them to design it that way?
I don't know. I couldn't
Damn.
tell you. It was so shocking to me. I was like, called the lender. I was like, I'm out. And he was like, you don't think you can make it work? Just write a number down. Maybe we can work something out. I'm like, I can't fix this.
Mm.
You know what I mean?
That's crazy. Do you know if it ever traded?
No, I don't think it has.
Damn.
Yeah.
That's crazy.
Yeah. Crazy though, right?
That is crazy to think
Yeah.
about. Yeah.
But I think this year you're going to see a lot of that happen.
I've seen some one of the first deals I ever did. It was an apartment building out in Indianapolis, and it was 1960s product, and some of the units were very funky layouts like that. But it's 1960s, right? And it was a long time ago. But for someone to build something brand new today, and with all the technology today, and to like go in with that is kind of crazy. But real quick, this is how crazy the market was. So that deal, bought it in 2019, 32 units in a suburb of Indianapolis called Greenwood, Indianapolis. It was called the Vicksburg Apartments. Bought it from mom and pop ownership. 1.2 purchase price, and renovated 50% of the units. This is how hot the market was at the time. And the broker that sold the deal for us, he was selling a deal next door, and he was like, we bought it for like 31 a door is what we paid. Renovated half the units. He's selling the asset next door, also 1960s construction, but bigger, for like 100 something a door. And he goes, I get you the same price. He goes, stop renovating the units. He goes, these buyers will pay more for unrenovated units than they will renovated units. And so sure enough, he got us the number. And I was like, he got us a few offers. And the buyer that we picked was a new syndicator. And he paid a 3.7 cap rate on actuals. This is a 1960s product. This thing never cash flowed when we owned it. It had plumbing issues up the yin yang. and in a suburb of Indianapolis, C-class property, paid a 3.7 cap, and he's raising money. So I wish him nothing but the best. I should probably look up the property on CoStar, but we bought it for 1.2. We sold it 2 years later for 3.1. We've renovated half the units.
Oof.
This thing had plumbing issues, 1960s, and I'm like, what is? That's how hot the market was, and that's when I pivoted into the boutique hotel game.
Yeah. You know, that I've had some situations like that too, where you scratch your head. You're like, am I missing something here?
Yeah,
Did I totally miss this?
I'm gonna look tonight. When I go home, I'm gonna look at the
I wouldn't
asset.
be surprised if they're
It's a
in
new
trouble
ownership.
for
It's a
sure.
new. It's got to be.
It's got to be, right?
And I think he bought it on a bridge loan.
Oh, even
Yeah,
worse.
yeah.
Yeah.
So, but that's how crazy the market was back then. What is the biggest mistake that developers make, especially when they get into developing their first project?
Making emotional decisions, focus more on their own personal taste versus like what the market's looking for. Like a great example is like, all of us could get on Instagram, look at beautiful pictures of homes and like interior design. Um, I mean, I always say like call like, 3 ladies that you think are very stylish and ask them what they would like. And there's a really good chance they're going to steer you towards the things that are selections and decisions you should make. And, I see a lot of developers that'll like build these like very like masculine looking houses where they have like lots of black and like the interiors are very stark and they don't feel very warm and inviting. And for a while that was like kind of trendy. It was a pretty short window, I'd say like 2 or 3 years. And it's just not it's not the thing that seems to be selling right now. And I think that's one of the biggest mistakes I see developers make is they like pick what they like instead of like picking what the market wants. It's kind of like okay, here's a good example. You know how many people you see like on Instagram, they're driving like these really tricked out like forest green sports cars?
Yes.
You remember when you were a kid? Like nobody wanted a green car.
Yeah.
Everything was black,
Yeah.
white, silver, Ferrari red. Now the green is like hot, right? But that's going in and out. So it's like you got to kind of do what the trend is and not so much like your personal choice,
Mm.
you know?
Yeah, that makes a lot of sense. And it's like going to these projects for whatever, regardless of what asset class you're buying, it's like you got to think about who is the ideal buyer when you go to exit, and what is that person going to want?
Yeah. And I think like, buyer profile is a really hard thing to kind of zero in on. Um, I actually was talking to a developer on like Tuesday about this and they were like, who's your buyer profile? And I was like, man, I have like 5. And they're like, for the same type of project? I'm like, yeah. And they're like, well, how do you pick for that? I'm like, you gotta be really careful and stay a little bit like neutral. You gotta kind of follow trends because like what you hope is like, say that, you're building a nice luxury home that's gonna get sold to like an empty nester couple. Might not be the buyer profile that everybody
Mm-hmm.
thinks is your
Mm-hmm.
buyer, but they tend to buy a lot of my homes. But then you might have a family, similar type size home and everything. You got to kind of pick this like on trend design so that like they want your product. Because if you try to like pick to one buyer profile, man, it's hard in luxury houses. It can be 4 or 5.
Yeah, 100%. And I think like when you're renovating a single family home to become an Airbnb versus renovating it to sell in the market, it's really 2 different design elements. Like I was thinking of the Scottsdale property when you're telling me this. I'm like, I designed that to get views online and to attract people that want to come stay, but I didn't design it in the notion of like, hey, we're gonna really like optimize the exit and find the right buyer to come in. You know what I mean? So that's interesting. But Austin, I appreciate you coming on the show, man. Dropping so much game, so much value. Where can the folks get in touch with you if they want to learn more? And more importantly, where can they get in touch with you if they want to do a project with you?
Yeah, so I own Lux Builders, lux-builders.com. We do raise capital for our projects with limited partners. You can always hit me up on Instagram at Austin Schmidt 2258 and love to hear from you. And thanks a lot,
And
man.
it's lux-builders.com. Go hit up my man, Austin. He's Austin Schmidt. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.